Ladies and gentlemen, good day and welcome to Varroc Engineering Limited Q3 FY22 results conference call. As a reminder, all participant lines will be in listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. Varroc Engineering Limited management is being represented by Mr. Tarang Jain, Chairman and Managing Director, along with Christian Päschel, CEO, VLS Business, Arjun Jain, President and Head, Electrical and Electronics Business, and T.R. Srinivasan, Group CFO. I now hand the conference over to Mr. Tarang Jain. Thank you, and over to you, sir.
Thank you very much, and good evening to everyone. Tarang Jain here, and I would like to thank you for joining the Q3 FY22 earnings call of Varroc Engineering Limited. Let me start first with the India business. The Indian two-wheeler industry volumes were lower on both year-on-year and quarter-on-quarter basis by 23.7% and 13% respectively. Against this background, India revenue in the quarter increased marginally by 2% year-on-year and declined only by 4.2% quarter-on-quarter. This is mainly attributable to the sharp increase in commodity prices during the year, most of which was passed on to the customers. The EBITDA margin of the India business was at around 10%, with margins impacted negatively by the time lag in passing through of the commodity price increases to the customers. So, speaking about the global lighting business now, the semiconductor shortage continues to persist globally and is expected to normalize over the next 6 to 9 months. The passenger vehicle volumes during the quarter have shown some recovery as compared to the previous quarter, but are still significantly below normal levels. The passenger vehicle production volumes in the current quarter in Europe were down 25% year-on-year. North America was down 13% and China was down 3%. This resulted in a 15.1% drop in VLS revenues year-on-year in euro terms, though it was 10.7% higher on a quarter-on-quarter basis. The VLS EBITDA margin improved by 510 basis points quarter-on-quarter due to the sequential revenue growth, customer recoveries for lower volumes and commodity inflation, improved operating efficiencies and better cost control. Our China JV revenue also grew by more than 20% on both quarter-on-quarter and year-on-year basis, with improvement in EBITDA margins. The quarter-on-quarter increase was of 250 basis points. Our project RACE, launched in Q1 of FY22 to improve the profitability of VLS Europe operations to best-in-class levels, has made good progress in identifying improvement opportunities across various parts of the business. And implementation of the identified actions is currently underway. The impact of the same will be more visible towards the later part of FY23. Our overall net debt levels have reduced during the quarter by rupees 370 crores due to improved operating cash flow and a weaker euro. The VLS operations are expected to start generating a positive free cash flow from Q4 due to the improved revenues and a better operating performance. Our order booking, I'm happy to inform you, is that our India business has been able to secure an overall net business win of rupees 580 crores or rupees 5.8 billion on a year-to-date basis, and most of these orders are new business wins. Our VLS business has won euro 105 million worth of new businesses on a year-to-date basis, though new ordering activity at the customer end is muted due to the backlog of current model volumes as a result of the semiconductor supply shortage. Finally, I would like to mention that we've received an interest from certain parties for a strategic partnership in our global lighting vehicle systems business. The management is in the process of evaluating the interest with respect to scope, valuation, timelines, etc. The investors are currently carrying out their due diligence of VLS, and there is presently no firm or binding offer that has been received by the company as on date. With this, we're happy to take your questions now. Thank you.
Thank you. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead.
Yeah, Michael. Firstly, on this debt reduction by 370 crores quarter on quarter, this is mainly to what, let's say, inventory reduction or debtor coming down? What are the main reasons behind this?
Yeah, I will take that question. So basically, this is driven by two factors. One is in the VLS business in the last quarter, we have seen a sequential revenue growth, about 10% in euro terms, and that has contributed to improving the operating cash flow. In addition to certain initiatives we have taken in working capital improvement. And during the quarter, we also came to certain settlements with customers for some claims we had related to commodity cost increases and capacity underutilization during the year. And so overall, you can see the VLS EBITDA margins sequentially have improved by 510 basis points, which contributed to the improved cash flow. In addition, the India business continues to generate positive free cash flow, which is also helping in reducing the net debt. The third factor is euro weakened against the rupee during the quarter by about 2 rupees per euro, and that means debt denominated in euro also reduced in rupee terms to that extent by about 60 crores out of the overall 370 crore reduction we had. So I would say roughly 20% due to exchange rate and 80% due to better operating performance, working capital management, and so on.
So there's still losses in the quarter, so you're at EBITDA level as well. So this is mainly due to working capital only, I guess. So I mean, I want to understand whether it's a payable increase which drove this or inventory reduction. So what happened exactly in this quarter?
Yeah, payables have been fairly at a constant level. So it is mainly inventory reduction and also some faster collection of receivables. So certain payments which were on account of tooling and engineering, etc., which are due from customers, we have been able to collect earlier. So that mainly has driven, plus the India overall positive free cash flow.
Got it. Now, secondly, on this VLS EBITDA, now if I look at the two plants that you highlighted, Poland and Morocco, there the EBITDA losses actually has gone up by almost 3.5 million euros quarter on quarter, and there's overall reduction of 10 million euro in the EBITDA. So the other plants would have contributed on 13.5 million euro improvement, while actually in terms of revenue, Mexico was flat, Czech was only 10 million euro increase quarter on quarter. This 13.5 million euro improvement in EBITDA came from where? Is it like some element of receivables from customers of the commodity inflation which came from previous quarters as well in this quarter?
A lot of the customer settlement happened late to the current quarter actually. So during the quarter we received, let's say, maybe settlements of something like let's say about 12 million euros. Out of that, 8 million or thereabouts relate to current quarter, and 4 million is related to previous quarters. Roughly, that's a broad split up. So essentially, there's certain price correction which we got effective during the current quarter, which are under discussion because of the cost increases which had taken place through the year, right from the beginning of the year onward, plus some capacity underutilization which was there because of the lower volume. It's a combination of that. And on the newer plants specifically, there are two reasons why we still don't see an EBITDA improvement. One is because the commodity price increases have been sharper this year, so which have offset that an operating leverage we got with the higher revenue. Plus, there have been some supply chain disruptions in terms of availability of materials, especially semiconductors, because of which there have been frequent changes in production line and some expedited freight, etc., which have also contributed to lower operating performance. But both are kind of expected to stabilize in the current quarter and quarter four.
Ashutosh, do you have any further questions?
Sorry. If I get it correctly, 12 million euros that we got this quarter, 4 million is related to previous quarters, right? In terms of pass-through.
Correct.
And secondly, there was some freight correction. Will that also include something related to previous quarters that we got in this quarter?
No, those are all prospective, effective in the current quarter. So out of 12, 4 is previous quarter, then 8 million is current quarter.
So, just to clarify, the 4 million was on account of some underutilization claims on certain programs of one of our major customers, which had to be settled before December end, because, the customers have, December end as their year end, and also some of these programs, end of life was also achieved. So the claims were due as per our purchasing conditions. So that was 4 million. And the 8 million was a general increase already granted by one of our major customers effective November. But obviously the commodity increases have been quite sharp in the last 1 year, more, and therefore we are expecting, certain increases which will come in, more from the January period onwards in Q4. So 8 million was by one of the customers who has actually kind of granted us price increases due to commodity-related, inflation from November onwards of last year.
That will continue in the current quarter.
And that will continue. It's like compensating us for the commodity price inflations actually over the last 2 years. But people like in India, for example, we have a quarterly settlement, while abroad probably sometimes is annual, or sometimes in case of some special situation where the increase in commodity prices are really tremendous, then we can go back and ask them. And that's what's happening now, that we will see, you can say a reimbursement of this commodity inflation going forward.
Okay, so you said that 8 million is related to last 1 year, November 20 to December 21.
No, November 21, only November and December.
4 million is related to previous.
4 million is related to the underutilization of these few programs of a major customer, over the last probably 1 or 1.5 years because of the COVID situation.
Okay, got it. And how do you see Q4, like say versus Q3 in VLS? What kind of revenue increase we can see quarter on quarter?
So see, what has been happening so far in the first 9 months, if I have to just state it simply, that with all the investments we had made in new plants and overall, VLS has a production revenue, including of course China, 50% of China, we should be doing a production revenue of 100 million euros a month. But what we have seen is that due to the chip shortages, we have seen an average, of only 68.8 million euros in production revenue in the first 9 months. So we are almost 30% down overall. It depends on which plant is more or less, but that's the issue, and that's the reason why there has been a cash burn for us in the first 9 months. But now we see from January onwards, we already see an improving revenue trend. The revenues are increasing by at least 10%, 10% to 15%. And this, of course, will help an overall situation of, no more cash burn. And also this price increases, due to commodity inflation, the reimbursement of that, we already got it from one customer, and we are also seeking from other customers in Q4. This will result in a positive, I would say, free cash flow. And also at the same time, we have seen that, we have got this Project RACE, which we have discussed, in the last 2 quarters also, that we have started Project RACE in June of 21, and we started implementing the ideas from, you can say, September, October of 21. And here also we see a momentum growing, and this also will result in better operational and overhead performance, in Q4 onwards.
Okay, got it. Thanks.
Thank you. Participants, if you have any questions, please enter star and 1. The next question is from the line of Aditya Jhawar from Investec Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. My first question is that we have to, repay a debt of about say 50 million euro by March 2022. So does that mean that the strategic sale decision that we are planning to take, the resolution will come before that?
Well, it is not necessarily linked to that. We are what you are referring to mainly is the facility we have in Czech Republic from a syndicate. So where we have an extension till March, and right now we are in discussions with the bank to roll over for a further period of 6 months. So the negotiation is going on independently. So there is some prepayment, etc., which I think can be managed out of the operating cash flow plus some additional debt raising that we are working on at the moment. So yeah, I mean, coming to the strategic stake sale, obviously we cannot yet be sure of the timing and the quantum of the investment, etc. So we are not necessarily depending on that to plan our cash flows and take care of our commitments. So this will be independent of.
Sure, thanks, Srini. So what could be the timeline broadly, if you can help us understand, for strategic sale?
This is a bit difficult to predict. I think you will know very well from your experience that these things can take longer or shorter depending on how the discussions go. So yeah, we can only say that we have received interest and the due diligence process is ongoing, and as and when we have a firm or a binding offer or a definitive agreement, obviously we will update the market and exchange. So yeah, it can take anywhere between, very difficult to predict. It can be anywhere between 3 to 6 months or even longer depending on the scope of the deal, the associated complexities and mechanisms.
Okay. The second.
We request you to hold. We have lost our connection for management. Please hold while we reconnect. We have the management line reconnected.
Yeah. Sorry, Aditya, the connection dropped. So I think these things are a bit difficult to predict, and there are multiple parties involved. It's not like we are engaging with one party. So we need to wait and see how things develop, and we will keep you all updated regularly on the progress as we go.
Absolutely. The next question is on order wins, specifically on EV in the Indian market. If you can call out specifically any order wins, so we understand that we have been supplying to Bajaj Auto for Chetak. But other than that, what are the order wins? Are there any progress in discussions? We were discussing with startups and few existing OEMs as well.
Yeah. So again, like we've talked about before, we have been engaged with multiple different customers. However, I think also like we have mentioned before, I think the focus really has been to drive execution and launches of the orders we have already won. Right. And I think today we are in a very, very strong position there where we have basically launched almost everything. We have either launched or for a couple of components we are in validation now, so we will imminently launch all of the products that we've been talking about, and I think that really is a significant for the Chetak, and that I think is really a significant achievement over the last quarter. Of course, next we also work on the three-wheeler. I think that is something that happens in parallel. And again, I think now that we will have level of capacity again, I think it bodes well, I think, really for the future.
Yeah. Thanks, Arjun. But, other than Chetak, are there any projects which can go for commercialization in the next 3 months, or we are at advanced stage of winning orders in EV components?
I mean, I think I'd rather not talk about where we are in terms of, I think before there's a business win, right? I don't think there is any point in reporting it out. So I think we'd rather wait for a business win before reporting it out.
Absolutely. Thank you. And the final question is on depreciation, Srini. So, is the capitalization of the new facilities, is it largely behind, and should we expect this 250 crore kind of a run rate on a quarterly basis, or how much increase we should expect from this?
I think by and large, capitalization of all the major facilities is done. Of course, there will be ongoing replacement capex plus some program-specific capex, but that should not kind of exceed the replacement rate. So it will be stable around this level.
Sure. There's a final question, if I can squeeze. What could be the EV contribution on a consolidated revenue, PLS and India put together?
Sorry, come again?
What could be the overall contribution from sale to electric vehicles that includes, Tesla, VLS as well as the India business?
See, India, I think, talking about, this year is not that much. And you're talking about, when you talk about EV, you're talking about the EV powertrain only. And over there, you're talking about the lighting, right?
Right, absolutely right.
So EV powertrain, in fact, we have just started, as you know, for the Chetak. So I think next year, if you talk about the EV components, I think we would be at least at a level of about 250 crores next year for the India side. Just on the EV powertrain, right, which will be largely an additional revenue. When it comes to lighting, our lighting portfolio, what we had last, this thing was about whatever revenues are, it's about between 10 to 15%. No, sorry, that was a market share. Christian, would you be knowing that what out of the total revenue, what percentage, would be the EV for the EV vehicles? What revenue would it be for the EV vehicles only, roughly?
Yeah, for example, Tesla, and
like
some of the other
and the Volkswagen programs and all that.
Yes,
roughly, I would say what about maybe 15% or 20%?
See, the Tesla is.
I would say
between 8-9%. But sorry, I think Christian. Sorry, go ahead.
Srini, go ahead.
No,
go ahead, Srini. So I believe it's between 15 and 20, 22, 25%.
So it could be about, you can say that let's say if we are on a production revenue side, if we are around 850 or 900 million, so you can just, maybe you can take 20% of that. So let's say, it could be anywhere between 150 to 180 million euros would be towards EV lighting, And in India side EV, we just started, so it will be a very small revenue this year. And next year, I think the revenue growth should be there in VLS also. So this number of 150 to 180 million will also grow. So there are chances of it going up to, maybe 180 to 220 or 230 million next year, at least.
Okay, perfect. That's it from my side. All the best, team.
Thank you.
Thank you. The next question is from the line of Abhishek Jain from Dolat Capital. Please go ahead.
Thanks for the opportunity, sir. How is the revenue contributions Europe versus North America in 9 months FY22? And how much growth or degrowth in each geography?
I think if you really take on a quarter-on-quarter basis, Q2 to Q3, North America actually was down about 1.4% in revenue terms. And if I talk about individual plants, I will not just say Europe, on a quarter-on-quarter, Czech was up by 10%, Poland was up by 40%, and Morocco was up by 17.7%. So this was, I'm saying, quarter-on-quarter, the increase in revenue. When it comes to a year-on-year change, obviously, as you remember, last year, in this third quarter was when we saw a V-shaped recovery. So obviously compared to year-on-year, North America is down 26%, Czech is down 33%, and of course, Poland and Morocco at that time were at a very, very low level. So there, Poland has grown 54% and Morocco has grown 48%. To last on year-on-year basis quarter.
Sir, I was asking the mix, revenue mix for the 9-month FY22, Europe versus North America.
Yeah. If you take it on a 9-month basis, North America, from a production revenue perspective, will constitute between 17 to 18% of the overall VLS revenue. Then the Europe together is about 55% is across Europe, which is Czech, Poland, Morocco, all put together. Then the rest of it is contributed by India, Brazil,
Turkey, China,
Italy, Romania, Vietnam, and all that put together.
Okay, sir. And given the geopolitical issues and sharp increase in the energy cost, how is the outlook for the Europe for growth and margin in fourth quarter and FY23?
Christian, you want to take that?
Please, can you repeat? I was not able to catch the question.
Sir, I was asking about the outlook for the Europe. Given the geopolitical issues and sharp increase in the energy cost, how is the growth and margin outlook going ahead?
So for me, the outlook, let's say, is depending, of course, on the availability of the semiconductors. But the overall situation is improving. Let's say month by month, we have, let's say, some good agreements in place. But let's say the dominating effect is the semiconductor. On the other side, we were able to reduce our costs, and therefore I see a strong improvement on our side according to the revenues we see. And again, for me, more important is that we have secured production, and as I said, we have some good agreements made with the customer. Therefore, I'm looking really positive to the next quarter.
Okay, and how is the margin outlook for the BLS for the quarter 4?
Okay, sequentially,
would you like?
Yeah, I'll take that. So sequentially, we should see an improvement on account of 2-3 factors. One is we are getting some price compensations from customers for the raw material price increases which have happened, including the energy costs that you mentioned. So those things, some of it came in during Q3, effective 1st November, which continue into Q4. Plus, there are some more agreements getting finalized now, which will be effective in Q4. And then we also see 8 to 10% higher revenue in this quarter compared to the previous quarter because of the improving situation on semiconductors that Christian talked about. And lastly, Project RAISE, a number of those initiatives are under implementation now, and those benefits are also starting to get realized and adding to the bottom line. So that also will contribute. So with this, in Q4, we hope to have a positive EBITDA margin in BLS overall, and which will be an improvement over Q3, and improve that further in the next year going forward.
And what is the current break-even point for the BLS in revenue terms after taking all cost-cutting exercise?
Okay, if you say in EBITDA terms, it depends a bit plant-specific because the different plants have different operating. But if you say overall at EBITDA level, if we can do a revenue of, let's say, 75 to 80 million euro per month, roughly in that range, production revenue, we should be able to have a positive EBITDA generation.
And if the revenue goes up to the 120 million euro, then what EBITDA can we expect?
Well, currently we have capacities with which we can reach a revenue of 100 million euro per month.
1.2 billion euros of production revenue. At that level, the EBITDA will be at it will be a double digit.
Yeah,
plus.
close to double digit. Yeah, just about that.
That is for the VLS, no?
Yeah, that's for VLS.
We are only talking about VLS.
And can we expect this sort of the numbers? Can it be possible in FY23 if the semiconductor shortage issues, semiconductors shortage issue easing up?
Yes, it depends on the rate of improvement, right? Because right now it's very difficult to say when things will become totally normal. Everybody is kind of, people are saying it can take anywhere between 9 to 12 months. So that's the expectation. So it depends on the rate of normalization. But yes, if things become totally normal and that means the OEM volumes go back to normal level and capacity utilization improves, then maybe towards the last quarter of FY23, we can look forward to?
So basically, next year we are expecting that we should be able to reach, because the situation is anyway improving on the semiconductor shortage front. It's improving, but it's not normalizing like what was said, that we can only expect not before third quarter of next financial year kind of a normalization. Or could go into the fourth quarter also, but we will see an improved revenue than what we have seen in FY21 and FY22. So we are expecting at least the production revenue to be over at least €1 billion is what our expectation is. And hopefully that should happen.
Okay.
Exactly, and I can, let's say, I can underline this, let's say, because it's not only on semiconductors. We have set countermeasures together with the customers to get rid of the critical components inside our PCBAs, and therefore, let's say, we can as well improve. But I would like to underline what Jane was mentioning.
Okay. And sir, rupee is appreciating versus euro. So although it's a positive for the overall debt reduction side, how would it be impact on the revenue terms of the VLS?
Yeah, it definitely has some impact, which we have seen in the last quarter as well, because in euro terms, the revenue grew by 10% plus, but in rupee terms, it was less, after around 7% or so. So this is something which obviously is beyond our control, but I think more important is to have a sustained margin recovery in VLS, I think, which will lead to overall improvement in the consolidated result, which is what we are focusing on. And the exchange rate can bounce back like it's already doing in this month. So we have already gone back up compared to the end of December. So those things, movements will be there, but that we cannot influence or not be distracted by that.
So overall, rupee appreciate versus euro is positive or negative for the company if this set up from the revenue losses from the benefit of overall debt reduction?
See, so overall, once the operating performance comes back to normal levels, which means EBITDA generation at the normal levels, etc., obviously, euro strengthening against rupee will be a positive one for the business, and the operating cash flow improvement will outweigh the debt increase, so to say, in rupee terms. So that's what in the normal course, but now we are not in the normal situation, so that way it's a bit of a mixed bag right now. So.
Okay. And sir, during this quarter, you have incurred M2M losses of around 22 crores on intercompany loans. So what is the size of the loan, and as the rupee is appreciating, M2M losses will revert in the coming quarter?
Yeah, that is the expectation, but once exchange rate reversals, which are already happening during February, the losses, mark-to-market losses will get reversed. So we are roughly talking about a €100 million loan, intercompany loan.
Okay. And my last question is on India business. In Chetak, what components you are supplying right now?
So we supply the motor controller, we supply the vehicle control unit, we supply the DC-DC converter, we supply also the switches, the telematics, the BMS, and also the charger.
And how much is the content per vehicle, sir?
I think we had a slide around that. So, of course, we can't reveal the exact content per specific vehicle, because vehicle to vehicle it will change. But I think in terms of what we stated, in terms of the total content that we would expect to do in an electric vehicle, a two-wheeler we expect we do around 37,900, around 38,000 rupees. And in a three-wheeler, we would expect to do around 46,000 rupees.
And what would be the SOB in this Bajaj Chetak?
So, again, right, I think defining an SOB, etc. at this stage, I think is probably doesn't make the most sense, right? Because the market is still evolving. Today, in general, like I spoke about, right? Actually executing everything we've executed, right? It is not just the Chetak, it's also the new Pulsar, which is also running in the background. With the semiconductor backdrop we have, I think that is really our position of strength right now with our customers. And I think utilizing that, I think we'll see where we go whether it comes to, whether it comes to SOB, whether it comes to content, whether it comes to new business wins.
Thank you, sir.
But we have the major market share when it comes to the Chetak, and when it comes to the three-wheelers, we are a single source.
Okay. Great. Thank you, sir. That's all from my side.
Thank you. The next question is from the line of Basudev Banerjee from ICICI Securities. Please go ahead.
Yeah, thanks, sir. Just continuing with the previous question, as you said, for two-wheeler EVs, roughly 37,000 rupees. How that must be including the existing components which you are supplying to normal petrol models. So adjusting for that, how much one should look at for core EVs, which is new per se, which were not supplied for petrol models?
I think in the calculation today, we have assumed, I would say, just give me 1 second. I think we've assumed around 6,000 rupees for non-EV components, so I would subtract from 38,000, 6,000, so around 32,000 rupees.
Okay, that's it. So, next question, if I look at your standalone numbers, I don't know if I missed something in the initial comment, where the revenue sequentially is down with domestic two-wheeler market being weak, but your other expenses up almost 20% sequentially, and your interest outgo also moved up sharply to almost 29 crore, up almost 12 crore from previous quarter. So I think these are the two line items which has largely resulted in PBT negative numbers. So anything one-off or how to look at them, sir?
Yeah, the finance cost is impacted by this exchange rate mark-to-market thing we booked on the intercompany loan. So that's a notional cost, that's not a cash out. And part of it or most of it will revert as and when the exchange rate reverses. So that's just
how much is that, sir?
That is 21.8 crores for the quarter.
Okay, thanks.
Okay, which was your
the
Other expenses were also higher.
Hello?
The other expenses also were higher.
Oh, okay. Other expenses are number of things included in that. That includes certain legal costs we are incurring in fighting off some patent litigation and some other costs included as well, plus some other operational costs, one-off incurred in the VLS business because of the, let's say, supply disruptions on semiconductors and so on. So it's a combination of multiple items.
So this patent infringement on one of VLS costs accounted in standalone.
So you are looking.
No, he's talking about the India side, not VLS.
Oh, you're talking about the standalone. Okay, standalone is mainly the legal costs and some other professional fee we had during the quarter.
So almost, sir, I can see 25 crore QOQ increase, which is on a base of 129 crore, is close to 16-17%. So how much one should look at as one-off in this number?
If you're looking at the standalone financial statement, not in the presentation, then the mark-to-market loss on the exchange rate on intercompany loans is booked under other costs. It is not under finance costs. The finance costs went up because last quarter we issued non-convertible debentures of 375 crores, which was mainly to fund VLS for the liquidity requirements and some loan repayments. And that is the one which contributed to a higher interest cost. It's mainly related to supporting VLS operations.
So standalone interest cost, there is nothing one-off, but how much one-off will be in the standalone other expense then?
Since I put a figure, I need to exchange rate is 21.8 crores, which is another cost.
Yes.
Yeah. So other than that, I would think it could be about the region of 3 to 4 crores. That's what I broadly remember, but I can check and confirm back to you later.
Okay, so broadly 25 crore means QOQ it will be normal. So that extra part is the one-off part roughly.
Yeah.
And in your results also, if you can explain about that patent infringement stuff where you also highlighted no provisioning for that. So what is it all about?
Yeah. On the patent infringement, basically there are total of 6 cases which are going on overall. And there in So this is in different stages of hearing, etc. in the court, and we had preliminary ruling in couple of those cases, which basically said we had to disclose, make certain disclosures in our supplies to customers regarding potential patent infringement and the risks associated. So far there has been no quantification or decision on any claim either by the party who filed the claim or by the court. So that is still open because we have contested the patents on prior art basis, which means those original patents granted to the other party were not valid because those were already widely and publicly known design information in the public domain. And those claims have not still been decided. Those are still under adjudication by the court. So based on the legal opinion we have, currently chances of, let's say, successfully fighting off this is, let's say, reasonable, and based on which, and it is not possible to quantify any potential liability. That's why we not made any provision, but just made a disclosure. And there are more hearings coming up in the coming months, so where we will get a clear direction on where it is going.
And how much has been the legal expenses for this in VLS, as you said?
On this case, probably would have spent something like, my guess is about 1.5 million euros, something like that, over the last year or so.
Okay. And last question for Tarun sir, like last quarter, you may also mention that because VLS is like going so at work for a prolonged period, so even you are envisaging if at all there is a good deal for VLS and it can get sold to some other global light makers. So any advancement on that angle, sir?
So here actually, like what our CFO just mentioned earlier, so here I think, there has been an expression of interest by, a few parties or also from the auto space, So we have been discussing with them, but we still have not received, a binding offer yet. The process is on. So just to clarify that, see, we are absolutely open to a strategic investor for our lighting business because for the simple reason that, going forward, we do see that the semiconductor shortages will remain for at least 9 months, to 1 year. And we also have to then, invest money. We have to invest in the growth. There's capex involved, other things. So it's good to have probably at this stage because already 2 years have gone during this COVID times and, obviously the revenues have been disrupted. We already made a large amount of investments which still has to see that level of revenue coming still in, which will take probably to reach that kind of capacity utilization. What we expect probably will take another 8 to 9 months. So therefore I think we had, like last time, there was a little bit of a mention there that we are looking at that and we are in discussions now. So it's going in a certain reasonable manner.
Partial stake sale or full sale as such?
No, it will be a kind of this thing. It won't be a full stake sale. It will be it'll be like a JV.
See, all those things are part of the discussion. So,
but it won't be a full stake sale.
Which entities, which geographies, what percentage stake, all those things are still open. So we are discussing. So it's too early to say whether it will be a minority stake or a majority stake or whole of VLS business or part of VLS business, etc.
It also depends on the valuation,
Yeah.
So we'll have to decide based on that. But there is a good amount of interest. That's all I can say. That's all we can say.
Basically, standalone India business, if it's able to do some 5,000 crore revenue at 12% EBITDA margin, so almost 500 crore of annual EBITDA, that will be good enough to suffice for the valuation where there will be no debt and if you hive it off, the whole debt issue will be also gone and then it will be a new growth path altogether. So, from that angle. And as you rightly said, further 3-4 more quarters of lower production can continue to impact balance sheet, so that will be the continued
Yeah.
And last question, sir, if you can highlight how to look at the sustainable tax rates down the line, because I can see so many comments on tax in this quarter result schedule. So if you can explain it now.
Yeah, it's a good question actually, because currently what's happening, the losses we are incurring in the newer entities, we are not able to, let's say, avail the deferred tax credit on those entities because they don't have an established profit record. So cumulatively, if I had to say, as of end of December, I think we have unaccrued deferred tax asset of something like close to 20 million euros, which technically we can accrue if there is so. It's a kind of off-balance sheet asset, if you want to call it like that. So that situation will continue for some more time till this entities reach the break-even point and generating consistent profits, say at least for 4 quarters, and after which we can accrue. So you may see in FY24 or something a sudden big deferred tax credit coming into the books, big amount once that happens. So on a consistent basis, if take into account the investment tax credit as well as the natural tax rates at the different geographies, for VLS we should have an effective tax rate of between 18 and 20%. That's what we expect. And India obviously will be around 30 to 35 depending on the business, etc. So weighted average for the group, I would say, is let's say around 23 to 25%, something like that.
And by when India can come down to 25?
See, we are carrying some tax credit. So originally we would have kind of used up by now or a little later, but now that's also delayed because of the COVID and reduced profitability in the last couple of years. So now we have to actually do the calculations again and see, but at least it will be sometime in FY24, I expect we can switch over to the 25% region.
Okay. Thanks, sir. That's all.
Thank you.
Thank you. The next question is from the line of Ashutosh Tiwari from Equirus Securities. Please go ahead.
Sir, I think I missed, you talked about definitely 1 billion plus euro revenue in VLS next year. But at that level of revenue, what kind of margin do you expect at EBITDA level in VLS?
I think it will be it can be a high single digit.
Okay. And how should we look at interest costs going ahead because of this debt reduction in this quarter as of December? So how should we look at the consolidated interest costs from next quarter?
See, while the debt level we are trying to kind of stabilize, and once the operating cash flow becomes strongly positive, which we hope will happen from Q1 next year, this quarter should be kind of break-even still or marginally positive. Then we can start consistently bringing down the debt. But at the same time, we have to also refinance some of the existing borrowings, like discussed earlier in the call. Facilities are coming up for maturity, etc. It will allow this to be a mixed impact, replacing some of the lower cost debt with the higher cost debt for the shorter term. So you will see in absolute finance cost for FY23 may not be very different from FY22. Okay, the debt amount average may come down, but the effective cost, the shorter run may go up somewhat. And FY24 onwards is when you will see a sustained reduction kicking in. Once we repay some of the higher cost debt and improve the mix as well as reduce the debt. So.
But this quarter the interest cost is around 52 crores, so it will come down from that level, right, in the subsequent quarters.
Subsequent quarters, see, if you are looking at the financial statements, whatever interest cost you are saying, that probably will continue. But for the purpose of our analysis in the investor presentation, we reclassified some exchange loss into finance cost on the borrowing, which is explained with the notes, etc. That amount is not likely to continue. To that extent, you will see lower finance cost going forward. Depends on the statement you are looking at.
Okay, got it. Thank you.
Thank you. The next question is from the line of Nikhil Rungta from Nippon India Mutual Fund. Please go ahead.
Yeah, hi sir. Thanks for my question. Sir, just one thing from my side. I mean, as an investor, we have seen it's almost 8 quarters that we have posted losses now. When is it that we can start seeing company into the green?
I would say probably it'll be probably from Q1 of the next financial year that we can see a kind of a PAT, I'm on a PAT level, positive, largely because of the higher revenues coming into the VLS business. And also because we will be getting by then a lot of our commodity prices, which we have been incurring over the last, not 5 quarters, that also we will see that has been compensated by most of our customers. So therefore, I see probably the Q1 of the next financial year to be a PAT positive. That means that hopefully with the higher revenues, we are not making a PAT loss. It's probably a smaller PAT loss, in Q1 in VLS, and India of course does a decent PAT. So overall, we see a small PAT positive in Q1.
Okay, and every quarter we have been seeing there is some or the other, if not one-off, then one-off type of thing. Last couple of years, say, continuing with COVID, auto slowdown, then we have semiconductor issue. So, and every time we have been impacted by the VLS part. So, as mentioned by participant before, Basu specifically, so why is it that we are looking for a JV in VLS? Last year as well we did a QIP, and I believe we have almost utilized the entire amount, and now again we are looking for a JV partner. So do you think we'll be in a position to turn around that business with the amount coming in, or won't it be better to hive it off and start focusing primarily only on the India business?
See, to be honest, frankly, the lighting business is a good business. And, when we took the business, if you may remember, in 2012, it was a very low EBITDA business, and with a lower level of revenues, we grew it. We doubled the revenues we increased the EBITDA from 3.8% when we took it to almost 9.5%, if you include China also, to 9.5% in the December 19 quarter. So the point was that over a period of time, we were able to improve the EBITDA. We could convert even some of the loss-making plants to profitability, like Mexico and India at that point of time when we took it over. And that's the reason we were betting, and we looked at market share growth in this business, and the customers also gave a thumbs up because we were doing a good job, in this business. It's just that, we had not anticipated the virus to be there. The virus, it was a situation which coincided with our heavy investment in the lighting business. And that's where we have been navigating this problem for the last 2 years. We thought, that, there was this shutdown in FY21, and then there was a V-shaped recovery, but we did not realize the extent of the semiconductor problem. We didn't expect the shortage to be there to such an extent, that it would again. So it's not that we don't believe in the business. This business will definitely turn around. It's only that we need the revenues. So we need the revenues. That's primary. Secondly, now we're getting back all the cost we've incurred on material back also from this January, from at least the majority of the customers. And thirdly, we are also now looking at, the Project Race. We are trying to look at improving our site operations. We're looking at overhead controls and also control of other costs, including even material costs. There are opportunities, So we're looking at, and plus also design to cost. We're looking at also designs, which can be more optimized. So this business is a profitable business, but you cannot do anything, without revenues. You need revenues, You can't just save yourself out of trouble. You need to sell yourself, So you need sales, to come out of a crisis. You cannot just do it through savings. And that's where has been the major problem in the last 9 months. But we see the revenues now, going up, like I said, by 10-12% already in January. So we see that this will sustain in every quarter. We are hoping for a better revenue. But the revenue will only stabilize probably by December of this thing 2022. That's the way we see it. And therefore we said that, look, we should still be there and we should get in a strong partner where together we can see how to look at strengthening this business, also going forward. But let's see how it pans out. I mean, we have to see how it pans out. So we are already in discussion. So let us see how it pans out in the end. But we will take the best decision for the company, for Varroc in the end.
Okay. Sir, just to continue from your comments, the last qualitative question from my side. You mentioned that the lighting, VLS lighting is a good business to be in. So is it a good business from the perspective of customers and the management, or do you really think it's good from the shareholder perspective?
No, I think it is a good from a shareholder. I think it's a profitable business. It is unfortunate that we are in this situation. This was not what we had envisaged, to be honest. And like I said, it kind of coincided with a capex cycle, in the 6 new facilities and 2,000 crore investment. The problem was that actually, that we have a lot of underutilization in our new plants, and then commodity prices. So a lot of things have come together, and that's why we have been navigating this, in a business which is a profitable business. So I feel that this business is good for investors. It is not. It is good for the shareholders. It's good for the investors. It is a good business, But yes, I mean, honestly, yes. But we have to be prudent because of so many uncertainties around. It's good to have a partner, at least, that we realize that alone running a global business, and in current times where you can't predict, the external environment so well, semiconductors or other issues, so. It's good to have a partner, and I think that today I think we're anyway working on our costs and also on our pricing, on our designs. With all this, I think this can be a stable business going forward. I'm quite comfortable in being and remaining in this business for sure.
Sure, sir. That's all from my side. Thanks for answering my questions. Thank you so much, sir.
Thank you. As there are no further questions, I would now like to hand the conference over to Mr. Tarang Jain for closing comments.
Yes, thank you. So I think we were able to answer the questions both around our lighting business and also the India business, and I think now we see after a couple of years, India of course has been quite stable in its results. Over the last couple of years, when it comes to lighting business, yes, there has been a lot of navigating to do. A lot of ups and downs we have seen in the last couple of years, but now we see definitely the light at the end of the tunnel, where we see that the chip shortages are getting better. The availability is getting better. I'm not saying it's still there, but I think that today, I mean, with like the 3 things: improved volumes, getting back the prices on the commodity inflation, and thirdly, a Project Race. We are looking at optimizing our costs at the plant level, as well as our overheads. So with all these actions, I'm pretty confident that going forward, that our lighting business will first generate positive cash profits, and then of course positive PAT as we go along over the next 9 months to 1 year. So so I would say that don't lose the confidence in Varroc, and especially in our lighting business. I think you will see improved results quarter on quarter as we go along. Thank you.
Thank you. On behalf of Varroc Engineering, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.